Vicky Dickey here. And again, I'm trying to find inconsistencies and problems that are going on in the market and bad advice all the way around. So this is one of the videos that I ran across the other day and wanted to bring it to the attention of my clients and for anyone who's listening and wants to listen. And this is what I would consider bad advice. And the reason it's bad advice is he actually contradicts himself in the video, which I find rather intriguing. I mean, he puts it on, he says, you'll regret buying stocks in 2023. And then he goes on to explain some things. The first statement I want to notice on here is that the NASDAQ has its best January in over 20 years. So you're telling me don't invest because it's had the best January in 20 years? I'm not quite understanding the thought process here. I'll put a couple excerpts in here. Highly advise going on and listening to it to yourself to see what he's actually saying. But there's a couple of points on here I really want to get on that really kind of irked me about what he's doing here.
In 20 years. Yes, you heard that correctly. The stock market is doing so well that Facebook and Nordstrom surged more than 20% in a single day. Jim Cramer says we're now in another bull market, which you can interpret that however you want. And
now, he's taking a hit on Jim Cramer, and a lot of people do that. And in Jim Cramer's defense, he's been around for a very, very, very long time. And like anyone else, he makes comments and statements that sometimes aren't right, sometimes are wrong. And he is one of those guys that actually stands up and says, hey, what I did was wrong here. Just to kind of add a little bit to this, let me show you what he's looking at when he says we're in a bull market and when somebody's beating up Oppenheimer saying it could go to 4,600 by June. Now, again, my son, as most of you know, gets on me about my Excel spreadsheets. So here's an Excel spreadsheet. Now, this is one of them I keep on, and everybody knows I update this on a weekly basis. So since the beginning of the year, as you can see, the NASDAQ's up 14%, the S&P's up 7%, and the Dow's up 2%. What I really want to show you is the trends, and this is one I haven't started updating yet, and I probably will. But this is the part that the young man is actually missing. And what he's missing here is that from its all-time high, the NASDAQ's still down 24%. Well, at one point, it was down 38. The S&P is down 13, and the Dow's down 7. I know that's great, and I get that. Are you supposed to buy it to high or buy it to low? And maybe I misunderstand something here, but I don't think that I am. The whole point is you buy low and you sell high. So the point is you buy the markets when they're down because they're going to come up. That's the theory and the thought process, okay? And again, I'm not saying buy, I'm not saying sell. What I'm confused about, but this is the point that Cramer's kind of talking to. And this was last week. And this just ended up for today. Look at where it's at from its bottom. The NASDAQ is up 20% from its bottom. That's a bull market, folks. And I think 19% for each of the other two. Again, if you went back to last week, because we had 2 down days, we had down day Friday and a down day Monday, came back a little bit today. I'm guessing they were both at 20. Well, again, 20% is typically a bull market. So, is Cramer wrong? The question isn't whether he's right or wrong, is whether it's going to continue. You have to look into this a little bit deeper than just saying don't buy. And again, I'm not saying to buy or to sell. My point is that this is what these guys are looking at. What they're looking at is that we're off the bottom. Yes, we've come off the bottom a couple of times last year, 2 or 3 times last year. We went up 10, 15, 20% and we went back down again. Is that going to happen? I don't know. It might. But the point is that the people that actually were buying at the bottom have actually made pretty good money so far.
And Oppenheimer believes that the S&P 500 could hit 4,600 by this upcoming June. But others like Morgan Stanley, Michael Burry, and Bob Dole warn that you should take profits while you still can because they think...
So, again, let's understand something here. What they're saying is that we've had a run. But here's the problem. If you didn't put money in earlier when the market was down, there's no profits to be taking. So again, there's a mixed message here. He's saying don't invest, but if you didn't invest, you don't have anything to sell to make profit on. Again, it's rather confusing. And I know he's got all the gyrations and stuff going on here, but the simple fact is you have to be in the market to actually sell something to make a profit. And, Burry and those guys are saying the same thing that we are. Hey, this may be a good time to sell some profit. Well, again, we're up 20% from the bottom. It might be a really good time. It may not be. I don't know. We have to determine down the road and for yourself whether it's a good time to buy or to sell. The point is, if you're not in and you're so fearful to be in, there's nothing to sell and make profit on.
think that we're in the eye of the storm before everything goes to That's why we should really cover some crucial reasons that you probably shouldn't be investing in stocks in 2023, how some investors are making a ton of money by following one simple report, and a new investment strategy that could potentially change the way that you build wealth on.
This is the one I want to get to. And I truly hate these reports. And they come out all the time. Like there's some great knowledge out there that no one else knows, that 90% of the active managed funds fail to beat the market. Well, here's the thing. Most of them aren't trying to beat the market. The vast majority of actively managed funds, and he doesn't explain this, he doesn't go into detail about it because he doesn't probably know. Every fund has a reason for being and what it's supposed to go after. Now, some of them have track the S&P, some of them track an international fund, some of them track treasuries, some of them track other things. So it's not fair to say that an actively managed treasury fund didn't beat the S&P 500. It's not supposed to. And again, he's not saying that it didn't beat the market because it doesn't explain whether they beat what they're supposed to be. Again, you might have an international fund that's down 20% this year, but what it's supposed to be tracking is a fund that's actually, an index that's down 30%. So it actually beat the index by 7. But the S&P might be up 17. So it didn't beat the market, which again, what is the market? Is it the Dow? Is it the S&P? Is it the NASDAQ? Is it the Russell? I mean, this is such a vague statement. It really bothers me because he's not the only one that says this. A lot of people do. It's just completely false. If you track the actually active managed funds and you actually see how they do versus their index that they're supposed to be beating, the vast majority of them overperform what they're doing. Now, again, do they actually beat the S&P 500? Again, different question, because most of them aren't trying to beat the S&P. Are they trying? Did they beat the Dow? I mean, again, I don't know, but they're not supposed to. So it's a completely unfair statement because you're comparing apples to oranges. And it really irks me when people put this up here. It's just not a correct statement.
500 over a 15-year period. Though sure, in the short term, you will naturally see some outliers, some of which are incredibly talented, and others are just lucky being in the right place at the right time. But what I found most surprising is that even the funds that do beat the market still have investors within them that wind up losing money. And a perfect example of this is what's called...
Now, again, talk about completely off base. He's telling you that people that are in a fund lose money in the fund. But what he goes on to explain here is that the reason they lose money in the fund is they don't stay in the fund. They sell out of the fund. They sell when the fund is down and buy when the fund is up. You make the best decision you can with what you have. Now, that doesn't mean you have to invest today. No. But when you invest, you do your research and you put your money in. And what he is right about is that over the long term, and he finally gets to this at some point, which is, again, the whole negative part of this, or the part that just makes no sense, because he completely derails this whole comment. If you invest for the long term, now, if you are buying a stock today because you think it's going to go up tomorrow, you're not investing. You're trading. And there's two different concepts there. And I'm not beating up either one, but people who are trading are not people who are investing. And people that are investing need to understand that investments are not for a day-to-day. Now, it's just like your house. Your house actually goes up and down in value on a daily basis. You just don't see it because it's not in your report and you can't see it on your iPhone every day. The dollar goes up and down every single day and almost minute by minute. And again, people don't recognize the fact because they just see it. They don't see it on paper. They look at their stocks and they go up and they go down and they freak out about it. But again, it doesn't work that way. When he's talking about this, again, the wrong answer. He's saying that people are losing money because they pull money out. Again, you can't blame the fund for that. It's not the fund's problem. It's not the investment's problem. It's like saying, hey, I bought into a restaurant. 6 months from now, the restaurant's not doing well, so I take my money out and it gives me half my money back. And then a year later, it's doing great again. And I want to buy back in and you don't understand why you lost money. It, again, makes absolutely no sense. But it's what he's saying here, and it irks me.
The Magellan Fund. This is the world's best-known mutual fund that had record-setting growth under the management of Peter...
Again, not to interrupt him one more time, but I don't know that the Magellan is the number one fund. To me, the number one known fund. And I'm not saying it's not the best fund or whatever. Everyone knows what Vanguard is and everyone knows what 500 is. I think if you ask the average person on the street if they know what the Magellan Fund is, they wouldn't have a frickin' clue.
Lynch from 1977 to 1990, and even despite their incredible success, having outperformed the market
Okay,
for
look at
over
this
50
outperformance. So if you'd put your money in and you'd left it in there, who would be complaining at this point? Who lost money? Again, I don't understand what he's getting at here. It makes absolutely no sense.
years by a long shot. It was reported that the average investor lost money during a period of time where the fund returned around 29% annually. So why are investors so bad at investing? Well, during those years, as you would expect, there were some really good times and some really bad times. And when the average investor bought in with the excitement at the peak and then sold off their investments when everything lost money, they locked in their losses and missed out on all the subsequent growth had they just held on and done nothing. Now, even though
What did we just say? If they're not leaving the money in there, they're not an investor. They're a trader. It's a different world. I don't understand why we're beating these people up. The fund did what it was supposed to do, return 29% annually. What's the complaint here? I don't understand. Now, he goes on.
though this sounds like a case of don't time the markets, it's a really important reminder that you should not be buying stocks if you're chasing returns and expecting above the average. Although speaking of the average, that is another problem that we really got to
No,
discuss.
we don't need to discuss it because you're answering your own question here. He goes on to explain that the stock market very rarely actually makes 10 or 12 or 8% a year. That it's one year it's up 20, the next year it's down 10. So it averages out. And again, that's the whole point of an average. And again, it's literally not even about where it started the year, where it ended the year. And I've had people ask me that. Well, the market's up 30%. Well, if you bought on January 1st, it was. If you bought on January 15th, like this year, it's up 14% if you bought on January 1. Well, if you didn't buy on January 1 and you bought on January 10th, you're probably only up 7%. So again, none of that is even makes any sense at all. These are averages and they're supposed to be averages. Here's what I really want to get to. He goes on about this other programs that he talks about having fraud and short selling. And I tell you what, I wish I could have short selling outlawed. It would be my pleasure. I don't like short selling. I think it's the wrong answer for almost everybody. And I know there's some issues about it. So at the end of the video, he explains to everybody the steps that you're supposed to do in order to make this work. And this is what I want to show you. So we started this by you don't invest in the short term. Again, you don't. If you think you're going to do that, you're just being stupid. Don't go all in. Again, diversify. You don't put it all into Tesla. You don't put it all into Apple. You don't put it all into one mutual fund either. You don't follow others. Again, that's why you're buying a mutual fund. Most people do, and what he's talking about or complaining about. Don't try to time the market. Again, you're not trying to time the market, but you can follow the flows, which is what I've been explaining to people what I'm looking for my clients. When I look at individual stocks, or I'm looking for trends, I'm not looking for anything else. When I show Excel spreadsheets and what I've got going on, you have to just understand that you might be buying now. Yes, you're buying down when the NASDAQ's down 24%, but it's also up 20% from its low. Okay. Again, don't be emotional. These are things that we should all know. One of the main reasons why most people need a financial advisor to walk them through all of this stuff so that they don't make the stupid move. So again, I'm not trying to beat this guy up, but I also don't quite understand why people don't understand what he's really getting to.
Losses on Wall Street bets. So again, thank you to Wealthfront.
And it shouldn't be about Wealthfront. And he has a couple of ideas in there, and I don't want to discuss the specific ideas because, again, that's not what I'm looking for. I'm looking for inconsistencies. And like I say, right in his own video, he sits back and says, he contradicts himself. You shouldn't invest, but if you're going to do this, well, if you did those, then all the things he told you not to do wouldn't be a problem today. So again, look at your long-term picture, sit down with your financial advisor, figure out what you want to invest in and where you're trying to go, and put together a portfolio that makes sense for you. Whether it's individual stocks, whether it's mutual funds, whether it's index funds, doesn't really matter. But sit down and put something together that works for you and stay the course. Because as I continue to say, until things change, they stay the same. When was the last time the market did not come back? It might take 6 months, might take a year. I don't know. It might jump up and down. My clients ask me, what is the market going to do? The only thing I can guarantee it's going to do is do this. It's going to go up. It's going to go down. And I don't know what's going to go back to its peak. But what I can explain to you is if you're not in the market, you're not getting any return. And if you're in the market, don't do it for a day. Again, you're not investing at that point. You're trading, which is a whole nother world. I'm not complaining about traders. Traders Most people that are trading should know what they're doing. And if you're trading and you don't know what you're doing, you're going to get hurt, just like he shows in this video. But please focus on what's important, which is you and your family. Do short-term stuff. Buy the market when you think it's good, and have all your investments fit your long-term goals. Don't focus on whether an investment is going to beat the market, which, again, we don't know what that market actually is. If your whole focus is following the S&P 500, then there are investments that actually follow the S&P 500. You can find active managers that consistently beat the S&P 500 because that's what they're tracking. And if you really don't care about active management, you can buy an index that literally tracks the S&P. So if the S&P is up 10, you're up 10, minus a small fee in there. But don't get discouraged by what's going on. Don't listen to the news when it comes to people on television, because one thing he doesn't explain on here, and it should be explained, if you're hearing it on television, you've already missed the opportunity, most probably. And I'm not saying that, I mean, there's some conspiracy theorists out there that think that the television shows out there, they'll come on there and tell you to buy a specific stock because they're trying to buy you out of a stock, or have you buy out a stock that they're upside down on, or they've made money on, want to get on. I'm not going down that road either. I'm not saying that doesn't happen. I'm not saying that it does. But you have to pay attention to trends and what's going on in the market. And yes, you're never going to get the bottom, and you're never really going to get the top. The idea is to buy something at a good price and sell it at a profit. I don't know anyone that's ever lost money and gone bankrupt because they bought and sold something at a profit. Dickie out.